then let us know where you are from or where you plan on going, which is a big thing too. So if you are thinking of going ahead and going somewhere, or if you got a place that you are either living today, where you plan on going, where you thinking of being, that's a big thing that it would be good for you to share with us as well. So let's drop either where you are or where you are going in the chat. And I know there's a few people that are in Mexico. Okay, I see you in Costa Rica. All right, that's big stuff. I'm sure a lot of us would rather be in Costa Rica at the moment as well. Because that for sure is one of those things where we were just talking about kind of just the overall way and way of life being a little bit different than where we are or how we're living today in the States. But then also as we start and we think about things in terms of where we're going or some of the motivations of why people are leaving the United States, and that's a big deal as well. So definitely share your motivation for leaving. Maybe if it's just you got a good job, or you're looking to change jobs, or you're looking to change your career, or maybe just simply if you are in a situation and you're like, hey, I want to just retire earlier. And that's nice too. I know a lot of the ladies are from the financial independence group. So if you are on that financial independence kind of route and you're thinking, goodness gracious, it would be nice to go ahead and just be able to make a move, be able to see what's next, be able to do what's next. That's something that we would love to hear about as well. So please share that. Somebody said that she's looking at Costa Rica, DR, leaving for more freedom. Girl, yes. Yes. And if you have worked like crazy, and you've definitely been like hustling like crazy, trying to make sure that you got everything together, trying to make sure that you're able to work 1,000 different jobs or 1,000 hours, like some of these folks, that's one of the things too that we just want to be able to make sure that everyone is aware of. And so we'll go ahead and jump in and get started. Looks like we're having a little bit of a connection issue, but I'll go ahead and drop it in the Facebook group to make sure everybody comes on over to our live here on the Zoom. And so we have somebody great here. And I always love when we have topics where we can connect issues that are currently going on. I'm quite sure a number of you all have already heard about, especially the issue where the young lady, and she was in Thailand, she making money, doing her thing. I mean, I always want to see a sister win. And unfortunately, some of the things that she was sharing, things went haywire. And so she was sharing, she was putting people on to great information. And in the midst of all that, it was, hold on, wait, you ain't supposed to be doing that. You ain't supposed to be working here on this good old travel visa. And sometimes we just don't know. And I'll say many times we simply don't know. And so we are moving and working in a direction where we're thinking, goodness gracious, this is a great opportunity. I'm now making a lot less, but I can live off a lot less too. Maybe I can start, promote, grow my business from this new place. And especially, goodness gracious, you can be so energetic and so ready to kind of take on the world and be so much more creative, maybe when you're able to get away from some of the stress that you have. And so that's something that so many people are doing, but are you prepared? Because you know, the tax bill always come, Uncle Sam be knocking at your door. And we want to be as prepared as possible and not let that derail so much of the success that we're having. And so when we talk about tax filing requirements, impacts of self-employment, if you're overseas, international taxation, because sometimes they want their money too, retirement planning for international travels, we have the expert with us today. So we have Katrina C.M. Haynes, CPA, who has over 20 years of experience providing U.S. citizens, U.S. green card holders, and foreign nationals with tax consulting and compliance services at some of the largest accounting firms in the world. She is a certified public accountant and is an active member of the American Institute of Certified Public Accountants, the National Association of Black Accountants, we always like that, and the National Society of Black Certified Public Accountants as well. And so we have a treat for you. If you are planning it out, let's do it right. So without further ado, I'm going to turn over the mic to Katrina.
Thank you so much, Rosalind, and welcome. Thank you for letting me come in here today and speak to you. I'm really excited. I'm going to go ahead and share my screen with you. And we're going to jump right in. I have a lot of information to share with you, and I know we are a little limited on time. And I'll say that because I could talk all day long about this stuff. So I just want to make sure that we get to the information that's as important to all of you. I believe that Rosalind is going to be monitoring the chat. So if you have questions, just jump in there, and we'll be able to stop as we're going through. And I want to make sure I get as much information to you as I can. So again, my name is Katrina Haynes. I'm a CPA with over 20 years of experience. I specialize in U.S. expatriates, U.S. taxpayers that are living and working overseas, and foreign nationals who are non-U.S. taxpayers that live and work in the United States. I'm the owner of Haynes and Associates, which is a tax compliance and consulting firm that provides support to individuals that have these issues and also other firms that have clients that have these issues and need some support. Before being full-time with Haynes and Associates, I was the global mobility tax manager for what I consider to be the best non-alcoholic beverage company in the world. And I also worked for many of the global firms. I worked for Arthur Andersen, Deloitte, Ernst & Young. But I always tell everyone my most important job is as mother to those people down at the bottom of the screen, all of whom are running around. It's almost bedtime. So if you hear them, I'm going to apologize in advance because, you know, COVID. So we're going to talk. I'm going to divide this session into three main topics. We're going to talk about tax return basics, and we're going to talk about other tax return considerations. We're also going to talk about some retirement income, and if we have time, we'll talk about tax preparation options, what things you can consider, and what things maybe not to consider if you're thinking of doing it for yourself. If you do have an international tax situation, it's not that you cannot prepare your tax return yourself, but it's just really important to have some sort of resource to provide you with support because there are a lot of nuance involved, especially the more complicated your tax situation gets. So let's start with the basics. There are several different ways that you can file your tax return. The first is as a full year resident or a non-resident alien, meaning you file a Form 1040. So a full year resident would be a U.S. citizen, a U.S. green card holder, or a non-resident alien would be a foreign national, someone who's not a citizen and not a green card holder that meets what's called the substantial presence test. I'm going off of the assumption that the majority of people here are U.S. citizens or green card holders. So this is the category that you would file in. You are taxed on your worldwide income and you're eligible for all elections and deductions and credits. Worldwide income meaning any income you earn anywhere in the world. That means if you are living and working outside of the United States 100% of the time, the US is going to tax you on your worldwide income, even if you never set foot in the country. I always liken the IRS to being your crazy ex that's going to hold on to you. And even though you think you've got away, they're going to say, oh, no, I got you. You're going to pay tax for us 100% of the time. So that's how we are as US citizens or green card holders. Now, there is a way to terminate your tax residency with the United States, but it does involve you giving up your citizenship. Or if you have a green card, it would involve you surrendering your green card. You have to surrender your green card to a consular officer. That means if you've ever seen a green cards have expiration dates on them. They also require that you do certain things. For example, you have to be physically inside the United States for certain periods of time. If you do that and your green card is administratively rendered to be invalid, that does not terminate your tax residency with the US. So you could have a green card that you cannot use for immigration purposes, but you are still tied to the United States as a tax resident, and you would still be required to report and pay tax on your worldwide income until you surrender that green card, or if you're a US person, until you surrender that passport and receive acknowledgement. So the second way you can file is as a non-resident alien or a full year non-resident where you would file the Form 1040 NR. Those taxpayers are only taxed on their US source income and they have limited elections, deductions, and credits. And then there's the dual status residents who file the combination of the Form 1040 and the 1040 NR. So let's say you do decide to give up your citizenship, you surrender your passport in July. So for part of the year, you were a resident and you would be taxed on your worldwide income from January 1st until the day you gave up your citizenship. And then for the rest of the year, you would be treated as a non-resident and you would only be subject to tax on your US source income, if any. So those are the three main ways that you can file your US tax return. There are also special filings, like, for example, the 1040 SR, which is for taxpayers that are considered senior citizens. For tax purposes, a senior citizen is anyone that's over age 65. They're still taxed on their worldwide income and eligible for all elections, deductions, and credits, but the amount of information they ask for is limited. So if you're living and working outside of the United States, that does not prevent you from filing a 1040 SR. What they're asking for is not as robust as what's on a general 1040. So they may not ask you for certain things, but they'll focus more on retirement, Social Security, things that taxpayers in that age bracket tend to have. And then there's the amended tax return, which is the Form 1040X, which is where you can report changes on previously filed tax returns. So if we're going through this information, this session, and you realize, oh my gosh, I should have reported this, or I didn't report my worldwide income and I should have. The 1040X is how you are able to report any changes to those tax returns. Now, the IRS keeps your tax year open for 7 years, meaning they have 7 years to audit you, but you are only eligible to file amended tax returns for the last 3 years. You also can only claim refunds for the last 3 years. So let's say you realized in 2017, I think would be due in 2018, 18, 19, 20. Well, so your 2018 return, which would be due in 2019, you realize you had a tax refund, you would have until the filing deadline, which in this year would be May 17th of 2021 to get that refund. Or if you had to amend a prior year return, you would have to do it within three years from the date that that return was originally filed without an extension or originally due. So now that we've talked about tax generally, let's talk a little bit about this population, taxpayers that are living and working outside of the United States, also known as expatriates. So the way the IRS defines an expatriate is it's a US citizen or green card holder that's living and working outside of the United States in a foreign country. This is not just the way the IRS defines an expatriate. This is the general definition of an expatriate. An expatriate is anyone who's living and working outside of their home country. But we are talking about, in this discussion, US citizens and green card holders. And they have to be in a foreign country. That means any country that's outside of the sovereignty of the United States. So we're not talking about taxpayers living in US possessions. We're not talking about taxpayers that are living in Puerto Rico. We're not talking about taxpayers living in American Samoa or the US Virgin Islands. It has to be a country that is outside of the sovereignty or of the United States. That also does not include international waters. There's a whole list of things that it does not include. A foreign country is going to be any country under the sovereignty of a government other than the United States. So as I mentioned, taxpayers living and working in possessions and territories are not considered to be living in a foreign country. Also, if you are living and working on a US military base, that's deemed to be US soil. So taxpayers that are living and working in the United States file tax returns in most cases, just as if they were living and working in the United States still. Okay. When we talk about these expats and them moving around the world, you also need to understand the difference between your tax home and your domicile. So the tax home is generally considered to be where a taxpayer has their regular principal place of business or their regular place of abode in a real and substantial sense versus your domicile, which is your fixed permanent home. The difference between the two has to do with your actions versus your intent. So your tax home is where do you return every single night versus your domicile, which is where do you intend to return after long periods of absence. For US citizens and green card holders, the IRS deems the United States to be your domicile, meaning at some point you're coming back. So again, it's like that crazy ex that's going to hold on to you because I know you're coming back. You broke up with me today, but I know we're going to get back together. That's how the US sees it, even if your tax home shifts. So for example, I was telling Rosalind before we got started, I lived in India for a while. I still had my domicile, I still had my permanent home in the United States, but my tax home shifted to India because that's where I was living. That's where I was coming back at the end of every day. That's where all of my things were. That's where my vital center of interest for a tax purposes were, but I was still domiciled in the United States. Even if I did not have a home in the United States would still be my domicile because I was still a citizen. When we start talking about state taxes, which we'll talk about a little bit later, we're going to talk about the difference between domicile states versus resident states and why that's important. In some states, you may not be able to terminate your residency unless you move to another US state. So you can be gone and have lived out of the country for years and years and years and may still continue to have a state tax liability. And we're going to talk about that in a little bit. So now that we've talked about what you have to include on your US tax return, I want to give you a couple of tips on how you can mitigate some of that taxation. So, if you're subject to worldwide income tax on your income in the United States, and you're also living in a country, let's say the United Kingdom, that's going to subject you to tax on your worldwide income there as well, you are going to be in a situation where you're going to have double taxation. Okay, so in order to offset some of that double taxation, there's two methods that we're going to talk about here. One is the foreign earned income and housing exclusion, and then we're going to talk about the foreign tax credit later. So the foreign earned income and housing exclusion, which is on Form 2555, it allows you to exclude from income up to $107,600. That amount is adjusted annually for inflation. So 107,600 is the amount on the 2020 return per person. So that means if a taxpayer and spouse are both working overseas, they can both exclude 107,600. You would just attach a separate Form 2555, excuse me, for each taxpayer. Okay. And qualified housing expenses are deductible from adjusted gross income if you meet one of the two tests. So, if you are a married couple and you live overseas, then you would either include housing expenses on one taxpayer's form or the other, or you could split them, but you can't duplicate the qualified housing expenses on both forms, just unless for some reason you are actually living in two different locations. So, let's say one taxpayer is located in Portugal and the other one is located in Belgium. Those countries are not close enough that you could realistically travel back and forth versus if one taxpayer is stationed in Germany and one's in Switzerland, it's pretty possible that you could travel back and forth just because the countries are so they're bordering countries. So the first test is the way it's written in the Internal Revenue Code. It's for U.S. citizens only, and it's the bona fide residence test. And in this test, the taxpayer has to be a true bona fide resident of another country for an uninterrupted period of time that includes an entire tax year. The taxpayer may not have issued a statement of non-residence to the host country's government. Now, and the taxpayer must generally be subject to income tax imposed by the host country. That does not mean you have to be living and working in a country that has an income tax. So let's say you want to move to the United Arab Emirates. United Arab Emirates does not have an income tax. They do have a value added tax. They have a goods and service tax. So you are paying tax. You just do not have an annual income tax filing. You don't have to file an income tax return. As long as you meet all of the other requirements to be a bona fide residence test, then you can exclude that 107,600 plus qualified housing expenses. There's also the physical presence test. So let's say you don't meet the bona fide residence test. This one's available for US citizens and green card holders. It's possible as a green card holder to take the bona fide residence test, but you would have to attach a treaty position that's kind of outside of the scope of what we're talking about today. Under the physical presence test, the taxpayer has to be physically present in a foreign country or countries, meaning you don't have to be located in only one country. You just have to not be in the US for 330 full days in any consecutive 12-month period. So for the bona fide residence test, you have to be a resident from January 1st through December 31st, meaning you have to live in another country. The amount of time you come back and forth to the United States does not matter under the bona fide residence test. For the physical presence test, your residency doesn't matter, but you have to be physically present in any non-US country for 330 out of 365 days. And the 330 days don't need to be consecutive. So, and for this test, a full day is a 24-hour period from midnight to midnight. So, we talked about what happens as far as the actual excluding of the earned income. I also want to point out that it's not just for dependent workers, meaning you don't have to be um, employed by an employer. You don't have to be normally would be a W-2 employee or someone who is getting a foreign wage statement. You can be self-employed and live and work overseas and take advantage of the foreign earned income exclusion as long as you have that foreign earned income. Now, when we start talking about the housing exclusion, the qualified housing expenses, which I mentioned, are rent, the fair value rental of housing provided in kind by your employer. So let's say you are a dependent worker, which is someone that we would consider having a W 2 or getting a foreign wage statement. If your employer sent you overseas and they put you up in housing, then everything they pay to you or on your behalf is going to be subject to US income tax, even if the money never hits your hand. So if they put you up in a house, a corporate house, then that house and the fair market value of that house is going to be subject to US income tax, but it would also be available for the housing exclusion. Any real and personal property insurance would be qualify for the housing reduction, occupancy taxes, non-refundable fees, rental of furniture and accessories, parking, things like that. You would not include things like capital expenditures, cost of purchased furniture or accessories, domestic labors like maid, gardeners, nannies, drivers, things like that, payments of principal on a mortgage, depreciation, or telephone charges. So the qualified housing expenses, this is not an all-inclusive list, but these are the things that the IRS mentions specifically. Qualified housing expenses lend more towards a temporary nature of staying versus the housing expenses that aren't qualified are for people who plan to be there longer term. Again, doesn't mean you can't take advantage of it. You just could not consider those particular um, costs or those expenses. You can also, in some cases, some people who move overseas indefinitely and take advantage of the foreign earned income exclusion, a lot of times they just don't take the housing exclusion at all because they do own the home. They are paying on their mortgage, they do have domestic labor and so on and so forth. Okay. So, this question I get a lot. First of all, how do I know how much exclusion I'm getting and why does it matter? So, it matters to determine how much exclusion you're going to get. So I just answered the question with the same question. So the foreign earned income exclusion, the way you look at it is for an entire calendar year. If you don't qualify during the year, it's still possible to take advantage of the exclusion. So let's say I move overseas May 1st. I decide to move overseas May 1st. By the time my 2021 tax return is done or is due April 15th of 2022, it hasn't been 365 days. So I don't know if I've met the physical presence test, and I definitely haven't met the bona fide residence test because I would have had to be gone from January 1st through December 31st. So that means whatever exclusion I get on that 2020 tax return is going to be prorated based on the number of days that I would actually qualify. It is possible to qualify in a following year because if I left in May, by April 15th, I'm not going to know if I met either one of those tests. So if I qualify in 2021, if that's how I end my qualification period, then I can go back to the 2020 return and say, actually, I did meet, by the time I filed this tax return, I did meet the requirements for the foreign earned income exclusion. And I'm going to take a portion of the exclusion on my 2020 return, even though I didn't meet the requirements until 2021. So I've got an example that says if your qualifying period is for the entire year, the taxpayer is able to receive 100% of the exclusion. So let's say I moved to Singapore January 1st and I was there through December 31st. My qualifying period is going to be 1/1 to 12/31 and I'm going to qualify for the entire exclusion. But if I moved in halfway through the year, then I would only get half of I would only get half of the exclusion. Put a question in here that says, what would be the tax home for a digital nomad? If you are a digital nomad, your tax home, I don't want I call you kind of like turtles because if you don't have a domicile, which you would as a US citizen or a green card holder, but if you do not establish a residency in the location that you're in, your tax home's going to move where you move, okay? Now, if your tax home is shifting as you shift, then the bona fide residence test is probably not going to be for you and you're going to have to look more at the physical presence test. Another question. Can you exclude the entire 107,600 if you're self-employed? Um, yes, You can. Can you pay yourself 106,700 and not be subject to tax since it's below the limit? If you are self-employed, it will exclude you from income tax, but it will not exclude you from Social Security tax. We're going to talk about that a little bit later, though. So that's a good question. We're going to talk about self-employment tax and some of the things that you should consider when we're going through that as well. So back to this slide. If you don't know, so in my example, I'm going on an assignment or I'm moving to Singapore May 1st. By April 15th, I'm not going to know if I meet the bona fide residence test or the physical presence test. So the IRS offers you, as a US person living and working overseas, a couple of different extensions to give you time to finalize your return and to prepare a proper return, because ultimately, um, a lot of times it's more complicated for international taxpayers because they may have to travel between different countries in order to gather their documents. And so the IRS is aware of that. So the first extension is automatic. June 15th, you don't have to file anything. Any US taxpayer, US citizen, green card holder that's living and working outside of the United States on April 15th, or in this case for 2021, on May 17th, your tax return is automatically extended till June 15th and there's no filing required. Okay. So, and that's every single year. You get until June 15th to file your tax return and um, you don't have to file anything. Now, if you do not meet that June 15th filing deadline, then you have until October 15th, which is the regular extension that everyone gets, which would come along with filing Form 4868. So you've got the June 15th automatic extension. If you don't meet that, then you've got the October 15th extension with Form 4868. Then you've got two additional extensions that are available. The third is the December 15th extension letter. This is literally a letter that you send to the IRS, and it has specific wording, pretty much, hey, I can't get my return filed. I need an extra 2 months. The IRS tends not to acknowledge this letter, but when you do file your tax return, you don't have to worry about a late filing penalty. If you had a balance due, you would still have to pay interest and penalties back to April 15th or June 15th. So that it doesn't remove any interest and penalties, but it gives you more time to file, and it prevents you from paying a late filing penalty. And then there's the January 30th, which is an extension specifically for the foreign earned income exclusion. So back to my example. So let's say instead of me going on an international assignment May 1st, let's say I moved to Singapore September 1st. So well, let's say November 1st. Make it easy. So November 1st of 2021, it's April 15th of 2022. There's no way I'm going to know either way if I qualify for the foreign earned income exclusion. If I do the June 15th extension, the October 15th extension, the December 15th extension, let's say I was in the US a lot, I didn't qualify for the foreign earned income, or I can't qualify for the physical presence test. What that Form 2350 extension does is it gives you until January 30th of the year following the filing year to file. So if I left in November of 2021, my tax return will be due April 15th of 2022. And I would have until January 30th filing that Form 2350 of 2023 in order to file my return. So what it does is it gives you time to meet the bona fide residence test. So let's say I get to September of 2022 and I'm looking at my days and I'm like, there's no way I'm going to meet the physical presence test. Then, because I had that additional time, I had from January 1st, 2022, and with the 2350, it allows me to get through December 31st of 2022, and then I have another 30 days to file the return by the deadline. So the IRS does offer some flexibility in filing to allow you to meet both of those or either one of those tests with these additional extensions. Okay, so that's the foreign earned income exclusion. Let's talk a little bit about the foreign tax credit. Depending on the country that you're in, the foreign tax credit may be it may be a better option, especially if you're in a country that has a much higher income tax rate than the United States. Despite what a lot of people think, the United States has it has a complicated tax system for sure, but our tax rates tend to be a lot lower than the rest of the world. So with the foreign tax credit, taxpayers have the ability to offset duplicate tax paid on income subject to US and foreign taxation. If you're living and working outside of the country and your income is not subject to foreign tax and US tax, then you are not eligible for the foreign tax credit. If you are foreign paid, but you are living and working in the United States, that income is not subject for the foreign tax credit. For both the foreign tax credit and the foreign earned income exclusion, you only have foreign sourced income based on where you physically were working. That means you can have a US form W-2 with 100% foreign source income. Or you can have foreign wages being paid by a foreign company and you can have US source wages. It's not about who pays you, it's not about what bank account they put it in. It's about where you physically are located while you are doing the work. Will determine if the income is US source or foreign source. A lot of other countries are going to tax you on your worldwide income. So once you become a tax resident in another country, then they may subject your income to tax on a worldwide basis. And then because of that tie to the US, you're also going to be subject to tax on the worldwide basis. So the foreign tax credit comes in credit in handy a lot here. For the tax to be creditable, it has to be the tax has to be primarily imposed against your income and compulsory, meaning it's required. And some social taxes are creditable. Most of them aren't. Mostly, France has two different types of social taxes that are creditable, and that's based on recent court cases where French taxpayers sued the CSG and CRDS. I'm not going to say what they are in French because my French is horrible. And then Mexico, their social tax is imposed like an income tax and is available for a foreign tax credit if you're paying into the Mexican social tax system. Tax credits are not allowed related to income that has been previously excluded. That means if you are taking the foreign earned income exclusion, you can take the foreign earned income exclusion and the foreign tax credit together. But if you have excluded $107,000 worth of your income, then you can't take a foreign tax credit on that income as well. The foreign tax credit is not refundable anyway. But if you've already, let's say you made $150,000, you can exclude, if you excluded 107,600 on the foreign earned income exclusion, you can't take a foreign tax credit on the whole $150,000, only on the difference between what you've already excluded and what income is still subject to tax after that. If after the credit, it's like I said, it's not refundable, so it's limited to your liability, and any excess is going to be carried back into a prior year to offset your tax liability or carried forward. If for some reason you decide to switch back and forth between a foreign tax credit and a foreign tax deduction, which would be reported as an itemized deduction, then you wouldn't be able to create a carryback or a carry forward, but you would still have to calculate the credit as if you were taking a foreign tax credit. I don't know why anybody would do it, but obviously somebody has done it because the IRS has a rule about it. Now, there are two methods. There's the cash method where foreign taxes are reported in the year that they were paid. So pretty much how we as when we think of income tax, how we would think of, you've got taxes coming out of your W-2, that would be the cash method. Those are the taxes that were paid. That's what we're going to report versus the accrual method where you report in the year that you accrue. So if you're in the UK has it does not have it has a fiscal tax year. It doesn't end on December 31st. So if you were going to report US income on a foreign tax credit and take a foreign tax credit, you might want to look at the accrual basis because that way it would match the information a little bit better. Okay.
We do have a question. She says,
Mhm.
if her US based company moves her to Costa Rica, high five to you,
Yes.
um, would it be US income even though her permanent address would still be Florida?
No. If you are working, it's where you physically are working. So if a US company sends you to a foreign country, you have foreign source income, even if it's reported on a W-2. That's a good question because a lot of people get confused by that. Okay. All right. So I know it's a lot of information, so just jump on it. Okay. Something else to be aware of, just because if you are considering going overseas, US income tax returns are not the only thing you have to be concerned about staying in compliance with. Another thing to be aware of is the foreign bank account reporting. This is really big now because the IRS is not the IRS, the Department of the Treasury, which is the parent company of the Internal Revenue Service. They are really aggressively cracking down on taxpayers that do not have reported foreign bank accounts. They are looking at it as if you are attempting to evade taxes, even if that's not the case. So For any US taxpayer that's a US citizen, green card holder, even a resident alien, meaning I could be a foreigner coming into the United States. I meet the substantial presence test. I'm in the US substantially. And now I have to file a 1040. Guess what? I got to report all my non US bank financial holdings to the Internal Rev to the Department of the Treasury or face substantial fines. So if you have an interest in signature authority over any foreign financial accounts and your aggregate value exceeds the equivalent of 10,000 US dollars at any point in time during the year, you have to file the separate form. That means if you have signature authority over your mom's bank account and she has $9,999.99, and you have another bank account for yourself that has $5 in it, guess what? You got to report them all. If you have 1,000 bank accounts with $1 in them, you have to report them all. So if you have this I see a lot. You have a bank account, you only keep a couple $100 in there, but then you had a $10,000 deposit just to move money from one bank account to the next, and it only sat there for an hour or so. You have to report that financial account and every other account. So it's at any point in time. And there's this legislation, this FATCA legislation that we're going to talk about in the next couple slides, which is how the IRS confirms that you're actually reporting this information properly. Because so many years we were on the honor system and that didn't work out so well. So this form was formerly the TDF, which is the Department of Treasury Form 90-22.1, but currently you report your foreign bank accounts on FinCEN Form 114, which FinCEN stands for the Financial Crimes Enforcement Network, which is a network that the U.S. Department of the Treasury created specifically to manage foreign bank accounts, U.S. expat taxation, and cryptocurrency violations. So they have three main topics: catching U.S. expats that aren't filing, dealing with foreign bank account compliance, and people with cryptocurrency. So it's really important to stay in compliance, especially because there is no tax due on your foreign bank account form. There is, and what needs to be included there, a lot of taxpayers don't understand. So if you're going overseas and you're automatically enrolled in a foreign pension, guess what? That has to be included on your foreign bank account. If you have if you're input in a foreign social security, if you're in, say, if you're in India and you have a provident fund investment, or if you're in Australia and you have a superannuation fund, then it's very possible that you have to report that information as well. Okay. The form is due on April 15th, but it automatically extends itself to October 15th. So if for some reason you don't file it by April 15th, then you do not have to file a 4868 to extend it to October. It extends itself. And it's filed directly through the BSA e-filing system. So you don't file it to the same place that you would file with the IRS. It's going to go directly to BSA. It stands for the Bank Secrecy Act. So it's going to go directly there.
And now this is a good question. Shar asks, with the way that foreign exchange rates work, what exchange rate are they using? So I guess she might be like right on the cusp. Like, I don't know, depending on what exchange rate you using, I might be 10,001 or 998.
Well, there's actually, the IRS has rates that they use, standard rates that you can use, but you can look, it depends on how detailed you want to be with this. You can look on the date, you can convert during that month. Let's say if you're close during one month, but not in the other months, you can convert during that month to see what the balance is, or you can use the exchange rates for the entire year, the average for the year. Sometimes I will use the exchange rate on December 31st of that year if I can't get one over the year. As long as you have a reasonable basis. The IRS, I mean, they can be very inflexible, but they're not, as long as if you have a substantial basis for the exchange rate you're using, if you found it on the internet, that's fine, that's sufficient. They just need to know that you took the time to even look into it. But I would say, if it was my client, I would say if you're that close, it's a form, there's no tax. The penalties, which we're going to talk about on the next slide, are substantial. And I do a whole class on just foreign bank account penalties and regular people that they're putting into prison for failing to file a foreign bank account. So I would say if you're on the cusp, go ahead and file and report it because it doesn't cost you anything. Literally does not cost you. So that brings us to the, what do you report? You're going to report the maximum value of the financial account at any time during the year. So again, if you are passing money through from one account to the next, you would pick the maximum value in the account. There are civil and criminal penalties that could be assessed. Civil penalties are adjusted annually for inflation, but now there's a non-willful penalty of $10,000. Before 8/1, August 1st of 2016, there was just one penalty, but they created a non-willful penalty of $10,000. If they determine it's a willful violation, then your penalty is up to the greater of $100,000 or 50% of each account balance. Um, Plus criminal penalties, plus potential jail time. What I've been seeing for people who you can't really prove that it's not a willful violation, what I've seen. What the department or the FinCEN is saying is you should have known to report this. And if you didn't, then it's willful. Okay. So you got to be really careful with this stuff. Most of the prison time I've seen, unless it was for people who just accidentally, most of the prison time I've seen has been about a year or a year and a day or 6 months in federal prison, 6 months home confinement. But that's 12 months too long for me. Okay.
Mom, you like just a year.
That's 12 months too long.
Where you at? If that's the case, now you can't come home.
Exactly. And a lot of it, what I've seen recently is people who just did not, they literally did not know. Now, there are some people who it's them and their accountant and their bankers and they all got locked up and they got 5 years. That makes sense. There's one taxpayer who, I think it was 2019. He ended up getting 5 years. Him, his accountant, and his banker all got 5 years. And then I think his bank account had 28 million in it, and they took 14 million for the civil penalty and then the criminal penalty, and he did 5 years plus his accountant and his attorney. So if you are delinquent in your foreign bank account reporting, there is a specific set of procedures where you basically file your last 6 missed F bars. So if we're doing 2020 now, so it will be 2014 to 2019. You can come into compliance, and then I have a specific wording that I use that just says why you haven't failed and that the income was not it was not willful. You put that in there. Just this was not a willful violation. The taxpayer wasn't aware. And then also, if there's any income related to those accounts, you got to make sure that that's included as well, because you can't just file your delinquent F bars and then you've got all this income that you earned off of those accounts and that wasn't included in. So here's another how do they know question, or why do they need to know? And the answer is FATCA, which if any of you have heard of this, FATCA is the reason why this is so much more important now than it ever was. The FATCA stands for the Foreign Account Tax Compliance Act. It was introduced into legislation in 2010 to detect, deter, and discourage the 3Ds, offshore tax evasion by U.S. persons through the use of financial institutions outside of the U.S. So when I was younger in my accounting career, I used to always work with taxpayers that had accounts in UBS Bank in Switzerland and in Grand Cayman. And it's because they did not report that information to the United States. Well, what happened, I want to say about 2005, I was working for a client who was a Swiss national, and he got a summons from the Internal Revenue Service saying, "We know you have bank accounts in Switzerland that you haven't reported, and you owe us money. You're being audited." We went through our records. We had asked him every single year. Every single year, he said that he did not have any bank accounts to report. And the partners at my firm told him, "Good luck with that. You need to hire an attorney. We're not helping you with this at all because we did what we were supposed to do, and we're not getting involved in this at all." And so what happened is the Internal Revenue Service went to UBS Bank and some other banks, and they call it a John Doe subpoena, and they asked for everyone who was a U.S. taxpayer that banked at UBS Bank to turn those records over to the Internal Revenue Service, and they used that to go and audit people, and they got a lot of people like that. I'm mentioning this because when I was talking about Financial Crimes Enforcement Network, I said their focus is three things: U.S. expats, foreign bank accounts, and cryptocurrency. The IRS just did the exact same thing with Coinbase, which is a cryptocurrency transaction ledger place. They are a very big cryptocurrency. They manage a lot of the transactions. They did the exact same thing this year. So don't be surprised for this is another reason, little off topic, but if you do invest in cryptocurrency, the IRS is asking you to disclose that. They're using that, my opinion, separate tangent. They're using that to be able to come back and audit you in 2 to 3 years when this legislation comes. I
We
said it
need to have
yourself.
you come back to talk about that. I know it's huge. Cryptocurrency is huge,
Yes.
but just the same way, Uncle Sam gonna be like, knock, knock, hold on.
Yeah.
I need my piece. And I
Yeah.
know a lot of people aren't accounting for that. So we may have to circle back around and get you to come back
Mhm.
and yeah.
I do a whole nother one on that. I got a whole nother session. I got a whole nother hour on cryptocurrency and what you need to report. So yes, we can come back and talk about that. But
Now,
I'm just
someone asked
mentioning
a good question too. She says, how does dual citizenship affect these requirements?
okay, so back to my conversation about the crazy X. Crazy X don't care if you with somebody else. Crazy X says you with me. Okay. The IRS does not care if you have another citizenship. The issue that you have as a dual citizen is if there is an income tax treaty in place, it's hard to use the treaty to your benefit because you don't the way the treaties are written, they exclude the citizens. So if I am a US person in Germany, I'm working in Germany, the treaty is going to work on my German tax return but not on the US return because the US crazy X, they've got me by the scruff of my neck, right? But if I'm a US citizen and a German citizen, I can't use the treaty either way. So it really takes a lot of tax planning in those situations because the IRS does not care if you have dual citizenship with another country. And in most cases, the other country is not going to care either. So in some situations, I actually had a call with a client today. They are considering getting citizenship in the Ukraine. And the reason they didn't do it is because they didn't want to impact their US tax situation. But I was like, it's not going to change your US tax. Like your US tax is what it's going to be regardless. You can go ahead and get citizenship in another country because it's not going your US situation is set. It's not going to change. Okay. So, good question. So for the US, what FATCA does is it requires 30% withholding tax on US source payments and pass-through payments. So what they're doing is they are extending the withholding requirements to non-US banks, to foreign financial institutions and non-foreign financial entities. So when you open a bank account overseas now, they may ask you for your social security number or your US passport. It's because they are required to report directly to the Internal Revenue Service all of your transactions. So your bank account thresholds, they're reporting any interest, any dividends, any capital gains. They're reporting that all the way back to the United States. So if you're in the US and you do anything, let's say you have an account at Raymond James, you're going to get a 1099 at the end of the year. That 1099 has 3 copies. A copy stays with Raymond James as the issuer. A copy goes to you as the recipient, and a copy goes to the Internal Revenue Service. That's how the IRS knows if you haven't filed. Any of those forms, the W-2, the 1099, 1098, all of those the IRS has copies of. That's how they know you haven't filed because they see these forms and there's not a tax return to match. With FATCA, they basically have extended that ability to non-US entities to report directly to the IRS that income from those institutions. So the honor system is not that anymore because the IRS already has visibility to what you should be reporting. So they have created, the US has created intergovernmental agreements or IGAs. I think we have about 113, 114 in place right now with different countries. If there is an IGA in place, then that country is required to withhold 30% for you and of US income tax on any of the payments made to you in that country and report back to the Internal Revenue Service. So just know if they are asking you for something for FATCA purposes, it is being reported to the United States. The IGAs allow foreign country entities that have US account holders to report it. So basically, you have to confirm what the IRS already knows. And again, there's no more honor system here. So now we've talked about a lot. Now let's talk about states because we've talked about what happens at the federal level. We've also got to talk about the states because if you're going to be gone for more than 2 years, you really should look at breaking your state residency as well. It's not as easy as just picking up and moving from the state, especially if you're in a state like Pennsylvania or Ohio or California or Georgia where they keep. So now you you've got the crazy X and you got the crazy X's kids that are holding on to you because they don't want to let you go, right? So you're always going to have, as a U.S. citizen or green card holder, a federal filing requirement. So that's not gonna go away unless you surrender your US passport or you surrender your green card like I talked about earlier. There's nuances with that as well because the IRS, if they determine you are surrendering for the purposes of tax evasion, and there's a couple different tests that they will use to determine that, then you may still, after you have surrendered your citizenship or your green card, you may still have to file US tax returns for the next 10 years if they determine that the purpose of you surrendering is for tax avoidance or tax evasion. So it is something that you can do. And also, as a green card holder, you surrender your green card, you sign paperwork. As a U.S. citizen, you surrender your passport, you surrender the paperwork, and I think it's like a $2,300 fee or fine or something to surrender your passport as well. So there is a cost associated with giving up your. And once you get rid of your passport, you can't come back. I mean, you can come back to the US, but you have to get a visa or you have to have you have to be a citizen or a national of another country where we have a visa waiver program, but you can't just come back to the US. You are now treated like any other foreigner and you have to follow any other immigration rules. You don't have rights. And then if you do come back too much or too soon, then that may trigger immigration to report you to the IRS and say this person was just they renounced their citizenship, but they've been here for the last 6 months. This looks like tax avoidance or tax evasion. If you are a resident of a domicile state, and we talked about domicile versus tax home, domicile states are going to have different rules and they're going to have it's going to be so much harder to break. So again, I mentioned just a couple off the top of my head: Pennsylvania, Ohio, California, Georgia. They're really, really hard to break. Some of them state that Pennsylvania in particular, you have to move to another US state to break residency in Pennsylvania. So if you move from Pennsylvania to Costa Rica, Pennsylvania is going to see you as if you are still living and working in Pennsylvania. So let's say you are in Ohio, and Ohio has a local income tax and a state income tax, and you have moved to Switzerland. So Switzerland has a local income tax, a cantonal tax. So you're always going to have to pay federal income tax. Then you could potentially have a state income tax. If you're in Ohio, you might have a local income tax. Then you've got your Swiss federal and Swiss state or Swiss local. You could potentially be paying tax 5 times on that same income. And also, some of those states are not going to acknowledge the foreign earned income exclusion. They may not acknowledge the foreign tax credit. They may not acknowledge certain visas and treaty positions. So it could be very financially costly, and is definitely something to consider when you're leaving.
I think
Some
that's big. Like,
That's huge.
I'm like, this is great. You was naming them off. I'm like, Jesus, how many checks you got to write? Now that's a question too, in terms of, so if you're in Pennsylvania today and you're like, oh, I'm tired of this job, I'm about to leave and going to Costa Rica, you might have to like pump your brakes, move,
Mhm.
get you another short-term place, and then establish so when we think about kind of that planning
Mhm.
perspective, someone in Pennsylvania may take 3, 6 months to actually leave because they got to get to a new state established. So
Yeah.
what kind of things are they like? They need a driver's license in the
Yeah.
new state, like those
You gotta
kind of things.
register your car. You gotta cut all ties, move your bank accounts, change your driver's license, register to vote in that new state. I know this, but a lot of people don't. There's about 7 states that don't have an income tax. So like Florida, Texas, Washington. The others escape me at this point in time. People mostly go to Florida and Texas just because of the weather. Not as many people go to Washington. I think Nevada's another one that doesn't have an income tax. So Utah, I want to say there's like 5 or 6. South Dakota, those aren't it. Mostly it's Texas and Florida. But say you change your residency to Florida, register to vote in Florida, move your bank accounts to Florida. You in make sure you change your even if you change your address, you don't have to necessarily physically move. It might be hard to do some of those things without physically moving, but making sure that let's say you don't want to physically move, but you've detached yourself from Pennsylvania in its entirety. You could use have a permanent address that's a mailing service that's based out of Texas or Florida or something along those lines, so that there is the appearance that you have physically relocated out of that state into another state. So one of the other things I wanted to mention is if you remain tied to a domicile state, then they can seek to tax your estate after you died. And I've seen that a couple of times. Georgia is a domicile state, and I'm in Atlanta, Georgia. And working for the best non-alcoholic beverage company in the world, we saw a little bit of everything. And every now and then somebody would pass away, and they could have been in Singapore for 15 years, and Georgia says, you're still domiciled here. You still have enough stuff here. We're gonna tax some of your estate. So in addition to dealing with the logistics, the immigration logistics of bringing a person, a deceased person, back into the United States, but also then having to deal with the additional tax liability. I saw this happen. One of my clients, this was a while ago, but she had left the United States when she was 18 years old, moved to the UK, obtained UK citizenship, married someone who was British, and lived there for the rest of her life, passed away. And it wasn't until after she passed away that her children realized that she was a US citizen because the IRS came after her estate. Okay. So we had to go back with the help of an attorney, a great attorney that I work with on weird stuff like this, go back and terminate her and basically surrender her passport, which wasn't worth anything at that point because she had been gone, but surrender her passport and ask for them to terminate her citizenship back to when she was 18 years old. And this is after this woman had passed away, so that they could not have to deal with the estate tax. But just imagine the stress and the toll on your loved ones when they're already dealing with you passing away and dealing with all of your affairs. And now we've got another country that we didn't even realize you were tied to, that we now have to go and hire some people to try to take care of. So it is frustrating.
Oh my
Uh,
gosh, that's huge. I mean, so many folks, I know in some of the groups, people are like, oh no, when I leave, I'm gone. I ain't never coming back. I know some people are like, oh, I don't have family here anymore anyway, or whatever it might be. And so we're thinking short term in terms of, I just got to get some peace
yeah,
of mind and get up out of here. But things happen. And unfortunately, my grandmother always used to say it's little graves and big graves. And so things happen, you can pass at any point in time. And so you may be thinking, I'm just trying to get out of here, maybe do 2, 3 years somewhere else. But Lord have mercy, like that's a
yeah.
big deal as a part of your estate planning. And I harp on estate planning all the time
Mhm.
in the group. And that's something that most people haven't thought of. So if you're leaving to go and how that actually impacts your situation. And we always talk about, people are like, oh, you can do it all yourself. So somebody out there using TurboTax and they did their estate planning on, the whatever Zoom and all that kind of stuff. And it's all these small caveats that you aren't thinking of because your situation is getting more complex and you cutting corners. And now you might screw over the next
Yeah.
generation that you were building all this wealth for anyway.
And we do not even have the time to get into being self-employed overseas and what kind of tax liability that can create, what filing requirements, and investing in foreign mutual funds, and having to deal with having a passive foreign investment company, or having a foreign retirement plan and having to deal with controlled foreign corporations. There's so much more to it. Sometimes it's just worth having a 30-minute conversation with someone to say, "Hey, here's my situation. Here's what I think. Is it really as straightforward as it sounds?" And I have conversations with people all the time, and it sounds good, and then they say something halfway through the conversation and my eyes get huge and I'm like, "Oh yeah, this is this isn't good." So, yeah, it's just sometimes it's just worth it to consider those things. Some other things to consider. I put purchase a sale at home in the UK, but it could be in any country. If you sell your home, then if you are still a US citizen or green card holder, you can still exclude a portion of the sale just as if the home was in the United States. Same as same as if you are going to have a rental property overseas, you would still get to exclude the same kinds of deductions. But you just need to be aware of when you sell your home overseas, whether it be a personal property or a rental property. If it's a personal property, then it's more straightforward. If it's a rental property, you also have to make sure that you're reporting things properly, because there are separate reporting requirements for foreign rental properties. But if you are paying off a mortgage on a foreign home, there is a separate gain or loss that you have to calculate based on the repayment of a foreign mortgage. So you could have an 100% excludable gain on the sale of the home, and then you could have an unexcludable gain on the repayment of your foreign mortgage. So that's just something to be aware of. We're going to talk real quickly about foreign pension plans and foreign social security, and then also be aware of income tax treaties if they can help. Now, if you're a US citizen or green card holder, they may not help you as much on your US filing, but they are available and able to help you on your foreign filings if you have them. So just want to be aware of that. We're going to go into retirement income real fast because I know I've talked quite a bit, and I just want to make sure that you guys are aware of this, because if we are going for the long term, just wanted to make you aware of the fact that your pension and annuity contributions are going to be subject to tax, as long as so if it is possible, depending on your employer, for you to continue to contribute to your plan. So if you are on a U.S. assignment and you're living and working overseas, then you can continue to contribute to your U.S. plans as long as they are written as such. Most of them are. I'm not going to get into this as much because it starts talking about Internal Revenue Code. Most of them are 401k plans tend to be. You can't have a non-resident alien that's not a resident of the United States contribute to a 401k plan, but a US taxpayer that's living and working overseas, that as long as you stay on US payroll, you should be fine with allowing allow, being allowed to contribute to your 401k plan and continuing to get that contribution, that deduction from your gross income. Any contribution to annuity is going to be non-deductible for tax purposes, which is the same as if you were in the United States. And then distributions, if you have not already paid tax on the income or the growth, then you're going to pay tax at distribution, just like if you were in the United States. Now, this is where a treaty position might come into play, because you would be subject to tax on that distribution in the United States, but you may also be subject to tax on that distribution in your host country. So you might want to look to the treaty to see if there are any remedies for that double taxation. If you contributed with after tax dollars, then you're only going to be subject to tax on your earnings or the growth. So if you contributed to an IRA, then you would only have to pay tax on the earnings, versus a 401k, you would pay tax on the entire amount. If For annuities, if the taxpayer made contributions to a qualified annuity, qualified meaning that it meets certain requirements under the Internal Revenue Code, then a portion of the distribution is going to be considered a non-taxable return of basis. For non-qualified annuities, then a portion of the payment is allocated to the costs and recovered tax-free, and the rest is ordinary income. So, um, just it's very similar to the treatment in the United States. One more thing I want to mention before we'll probably do a couple of questions if we have any, is totalization agreements, because I know that some of you are self-employed or maybe moving overseas to be self-employed, or even if you are on an international assignment. A totalization agreement, I've mentioned income tax treaties a couple of times. There are U.S. Governmental income tax treaties. There's the FATCA intergovernmental agreements, which are separate, that are just for FATCA. We've got the income tax treaties, and then we've got the totalization agreements. Totalization is a separate Social Security specific treaty, and it directs payments when an individual is subject to social tax in multiple jurisdictions. So I'm Katrina. I'm on a US W-2, and my employer sends me to Singapore to work. Now, because I am employed by the US employer, the employer is required to withhold and remit US income tax for me. Okay. Now, if I'm in Singapore, Singapore may want to withhold and remit tax for me as well, which happens quite a bit. But I could also be subject to social tax in Singapore. And if I am subject to social tax in Singapore, then I'm now paying double social tax, and I may not ever get the benefit of the social tax payments that I make in Singapore, especially if I'm only going to be there for a couple years. So if that's the case, we would look to a totalization agreement, which would say Katrina has to pay social tax in the US. She also has to pay social tax in Singapore. She's only going to get a benefit in the US. So we'll keep her there and exempt her from social tax coverage or payments in Singapore. This only works if you are continued to be tied to a US employer. So if you go directly to Singapore and you just walk in and you get a job there and say, "Hey, I'm here to work," and they put you on payroll, you cannot exclude your income under, or your income from social tax under the totalization agreement. It's only if you are still on a US payroll somewhere, okay? In order to do that, you would have to get a certificate of coverage, which is just that. You go to the US Social Security Administration's website, you tell them what country you're working in, you ask for a certificate of coverage. Normally your HR department would do that. And then that certificate goes to the payroll department of the country that you're in, so that they have proof if there's ever an audit as to why they're not withholding social tax for you. Now, if you're self-employed, the certificate of coverage works the other way. So now I'm Katrina, self-employed, going to Singapore, and I'm working overseas, now all of my income is subject to US self-employment tax, right? So what is self-employment tax? It's FICA, Social Security, and Medicare. It's my portion as the employee and also the employer portion. So it is social tax, right? If I am a foreign self-employed, if I am a U.S. person self-employed in a foreign jurisdiction, what the totalization agreement does is it says you, Katrina, pay social tax in the country where you're living. Normally, it would say the country where you came from, but since the payroll moves with me, I, as a self-employed person, am working in Singapore. I'm subject only to self-employment tax in Singapore, and I would get a total certificate of coverage in Singapore to exempt me from U.S. self-employment tax. I do this for my self-employed clients all the time. Is I give them direction: go get a certificate of coverage to show that you are paying social tax in your host jurisdiction, and we can exempt you from U.S. self-employment tax. Okay, so then you would have to, it talks about you would still include Schedule SE, which is where you report your self-employment tax. And then you would add a statement that you are exempt from US tax because of the totalization agreement. Sorry, we had a meltdown over here.
Now that's a good place for this question. So we have someone who is self-employed and she's done some research to exclude the 107. So she's thinking, okay, so she just pay herself the 106, stay underneath that exclusion. Is that going to have any impact? So she needs to go get that certificate of coverage. But other than that, would she be kind of good to go where she is?
She would have to get the certificate of coverage because that's the only way she's going to be able to be 100% tax free.
So yep, girl, go get that coverage. Get that today.
Yes. So that's the only way you're going to be able to exempt yourself, because otherwise you're going to still have to pay that self-employment tax. Hold on just a second.
And that's big. I mean, so many people are saying, great, I can now take the great skills that either you've grown here, you're given to somebody in corporate America, and you want to be able to profit off those as much as possible and kind of take your life back, get some balance back, and so forth. So if you're moving overseas, kind of as we talk about these checkpoints, the first one looks at what state are you moving from? Because you might need to change that. And after you go from that, what state are you going for? That certificate of coverage and looking at how much you need to pay yourself, really kind of go like a step by step of, you might have a day where you like, I'm just going to quit and I'm leaving. Well, maybe not so fast.
Right. Because you don't.
A little bit, you might need to do a happy hour and have some time to chat with friends and so forth to calm it down, and then strategically do it so you don't lose so much money paying taxes.
Right.
Just because you made kind of that, and trust me, and I had them days, I'd be like, you know what, y'all can have this, but you might want to say, wait, let me go through a few steps to get things in order before you do it.
100%, 100%. Because especially with if you're self-employed, you have the flexibility of being able to work anywhere, and it is so enticing to be able to go other places and and experience the culture and just get a nice little change. So just like I said, just a quick 30-minute conversation sometimes can make a world of difference and can save you in the long run, especially as you're navigating an international workspace. So I also want to mention just real quickly that Social Security credits are based on your earnings, and you earn a credit for every $1,300 of earnings that you earn during the year, with a maximum of 4 credits. So people always say 40 quarters, but it's really 40 credits because you don't necessarily have to work for 40 quarters. You can work for you can make that amount of money in 1 credit, and you don't necessarily have to work for the 40 quarters. But if you lived or worked in a totalization country, then you could be eligible for benefits if you didn't have enough credits in either country. So let's say, for example, I'm Katrina, I go to the UK, I'm directly going to the UK. I worked in the US and I worked in the UK and I made all this money and I decided I'm going to retire early, but I don't have enough credits in either the US or the UK to draw benefits in either country. I can use the totalization agreement to combine those credits in either one country or the other. In most cases, it's your country of nationality. So in most cases, it would be the US. I would be able to pull those UK credits into the US Social Security system to get me more US Social Security. So there's a lot of different ways that the totalization agreements can be beneficial. Also, foreign Social Security. So US Social Security is subject to income tax at 85%. If you are paying into foreign Social Security, now remember, I mentioned the totalization agreement is for Social Security tax payments paying into. Once you start receiving social tax benefits, that's when you go to the income tax treaty. And in the vast majority of cases, if we have an income tax treaty, then you are only going to pay social tax in the country where the payment is made. Okay. So if I'm getting US social tax or social security payments, I'm going to pay tax on them in the US. If we have an income tax treaty, then that income is not going to be subject to tax in my host jurisdiction. If we don't have an income tax treaty, all bets are off regardless. But if you do have social tax payments, then typically they are only subject in the country where the payment is made, or where you basically who's the country that's providing the benefit. So if for some reason, now back to my conversation about working in the US and the UK, if I have payments in both countries, I would only have to pay social tax in either one country or the other. So with that, we are that's the information I wanted to present. I did mention talking a little bit about knowing how to self-prepare or when to self-prepare. There are a lot of good softwares that are out there that are really intuitive, and some people are more knowledgeable about the tax legislation than others. But when you are getting into international spaces, it's probably a good idea just to do a quick gut check to make sure that you are understanding the requirements, especially before you go, just because it's always easier to fix it before you've left than to change it after you've already done something. So, um, someone asked what a private consultation looks like. For I can't speak for everyone, but for me, I do 30-minute consultations, um, and I ask people to come with the questions that they have so that we can kind of talk through what their questions are. But it doesn't really it I mean it's just a conversation. Unless we are digging deep into specific scenarios. I always say this: if I don't have to open up a book, I don't have to charge you. Once I have to start looking in books and things like that and doing a lot of research, then otherwise it's just a conversation. So as long as we're not digging into really specific applications of different scenarios, then for me it's just a conversation. But there's a lot of people out here that do this kind of work.
So she said she gonna pay. So what does the pay look like? So what documents does she need to bring for that?
I will say, reach out to me on my website. Go to hayneshelp.com. And if you go to the contact us section, there's a link to my calendar. Just book 30 minutes on the calendar, and we'll talk through specific questions, and then we'll discuss that separately. Um, of course. Someone asked, they're doing conversions from pre-tax to Roth and will domicile in Florida. So the only tax you may have to worry about is foreign treatment of the Roth. Um, once you, that's a very loaded question. So generally speaking, the answer is yes, but there's a lot more that could be under that. So I would need more information to be able to answer that question. But because it's a very broad question to say all I would have to worry about related to this specifically, potentially, but there's,
That's why you gotta get your consultation.
yeah. I need
Put the
more.
website in the chat, so go there, get your contact us. And I know a lot of these questions are people who are like on the cusp, they're about to go. And then I know from the previous, when we were doing the intros, a few people are already there. Now, if you are already there, one question I have is how far back should one go you forgot to disclose something, you on this and saying, oh, I ain't even know that. So if you're having one of those, oh, damn kind of moments, how far back should you be prepared to start? Okay, now I got to fix something, revise some disclosures or what have you. If you've been on 20 years, that might be a bigger problem than if you've only been on a year or so.
Yeah.
But what should people be thinking about, and how far back should they be planning to fix items?
So if you've been gone, the IRS has a specific program for streamlined disclosures. So let's say you have been gone for 20 years and you haven't been filing, and you realize, oh my gosh, I need to get into compliance. This happened a lot when they started cutting stimulus checks for U.S. people living overseas. A lot of people came out of the woodworks and said, I haven't been filing, but I want my stimulus check. So the IRS, under the streamlined filing, you go back the three most recent missed tax years. So right now that would be um 17, 18, and 19. And then you have to do the last 6 years of delinquent foreign bank accounts, which would be 2014 up through 2019. Now, if let's say you only hit the threshold for foreign bank accounts one time during that period of time, then you would only have to report that one foreign bank account. Now, let's say this is your second year living overseas, and you're like, oh my gosh, I don't know that I did anything, or I got overwhelmed. Then you could still just go ahead and file a tax return, or if you filed a tax return and you feel like you didn't get it done 100% correctly, you could just file the return now. Um, I always say, as long as you get it in before the IRS gets to you, you're in good shape. For your foreign bank accounts, there are specific delinquent foreign bank account procedures that would ask for you to go back 6 years. But again, if it's only one, it's just making sure that you have the right verbiage when you are explaining why you did not file your tax return, so that there's no ambiguity as to whether or not it was a willful violation versus a non-willful violation. So, long answer to a short question: 3 years at the most if you've been gone for a long time. If you've been gone less than 3 years and your tax returns are still open, I would say just file the returns, unless you have foreign bank accounts or other foreign informational forms that need to be filed as well. Then you need to go under streamline because you get that protection.
Now that's the thing too. So on the foreign bank account, so if you've had $9,000 for 5 years, but just one of those years you hit the 10,000 mark, you only need to disclose that 1 year.
Yes.
Oh, that's perfect. Okay.
Mhm. Yeah. So a lot of people try to keep especially if they don't want to file it, they just try to keep their accounts under that amount. But it's all of your foreign bank and financial accounts, which for some people could include their pension and things like that as well.
Now we have a question. We have someone who lives abroad. She's living on her cash savings, no income. She's wondering, does she have to file a return? So I guess one question would be, are you getting interest on that savings account or brokerage or any kind of returns there too? That might have an impact. But I guess in general, based on her question, just assuming she has all of her money sitting in maybe just a savings account.
If you don't have any income that's above the threshold, then there's no filing requirement. So let's say if you made $5,000 total, because that's what you made during the year and you've got a lot of savings. As long as that's your global income and you're below the filing threshold, so for a single person, I think it's like $12,000, $12,400. As long as you wouldn't have a filing requirement in the US, then you don't have a filing requirement overseas. What trips people up is they'll say, I made $50,000, the foreign earned income exclusion is 107.6. I don't have to file. You do have to file to take advantage of the foreign earned income exclusion. It is an election. It's not something you automatically get, so you have to file to take advantage of it. So if you do not file to take advantage of it, then you did not qualify for the exclusion. So if you just made less than the regular air quotes filing requirement of for single people, I think it's like 12,400, then no, you wouldn't have to file a return because there's nothing to report. You wouldn't file if you were in the US, so you wouldn't have to file overseas either.
Now, one thing too, especially for self-employed people, typically if you're on the self-employed side, you're paying the quarterly estimated taxes. Are you still paying that in whatever foreign country as well?
Yes. Yeah.
and get away from it. They just be turning left.
Gonna hold on to you.
Home. Now, one thing too, so somebody is sitting at home today and they're saying, I am leaving this place in the next 12 months.
Mhm,
What are some of the more tax-friendly states? I know you mentioned Texas and Florida.
mhm,
So they need to figure out, okay, how do I get there? Start researching how do you obtain residency in those states?
mhm.
Can you list maybe either some more states or in addition, some tax-friendly countries? So as you're going over there, I mean, you mentioned one where it's like 5, 6 taxes and everybody want a piece of your check, you ain't gonna be left with nothing. What are some places that are gonna be a little more friendly in terms of from a tax perspective if you're doing some of that planning, and especially if you're open, you just know you leaving here, you don't know exactly where
Yeah.
you're going at the moment.
So I can okay, so states, it's Alaska, Florida, uh Nevada, South Dakota, Texas, and Washington and Wyoming are the ones that don't have income taxes. Tennessee only taxes interest, dividends, and capital gains. So those are the states to consider. From a country perspective, that one is a little it's a little harder to say just because what makes them tax friendly varies. Some of them it's easier to invest. So a lot of the Caribbean countries are very tax friendly because they're very open and easy to invest in. Every 3 months or so I see a list of countries that are the easiest to retire in. These are the most popular countries to retire in. But ultimately, it comes down to what you're looking for. Every country is going to have its benefits. So, for example, I hear people all the time tell me, "Oh, I'm going to go to United Arab Emirates. I'm going to live in Dubai because I don't have to pay income tax." Well, first of all, United Arab Emirates is extremely expensive, and even though you're not paying an income tax, you are paying a value added tax. You are paying a goods and service tax. You are paying tax. You're just not filing an annual tax return and filing that way. So it's and as a US citizen or green card holder, you still have to pay US tax on your worldwide income. So you living and working in Dubai is doing nothing for you other than you just, you know, you're living in a beautiful place. It's very beautiful over there. But, it's also extremely expensive. So I think it just depends on what you're looking for. Um and kind of start from there. But I'll send you some information, a couple of articles that I found where it talks about retiring overseas and they're friendly. A lot of them are broken down into if you want this, go here. If you want that, go there. So I'll send you something and then maybe we can share it with the.
Yes, that's good stuff. I'll definitely share it with everybody. Now, my final question that I have, so definitely if you all have any other questions in here, is, and I definitely I hear it 100 times, and I'm always like, I'm a big proponent of build your team. Don't be cheap on yourself. So people like, I could do this, I don't need this, I don't need this. So I'm sure a number of people are doing their, online tax preparation. They like, I ain't paying nobody, I do it on my own. um, doing the same thing with your legal documents and all those kind of things. What's going to be one of the bigger differentiators? And this is an easy question probably for you to answer between you and an online tax preparation type software.
So yes, that's easy to answer. The softwares online, they are really good in 99% of cases. I will 99% of domestic cases, okay? Meaning you don't have any international components, okay? The problem is there are rules and then there are rules inside of the rules that aren't necessarily going to be addressed by an algorithm. So, for example, if you are a foreign national that lives in the United States and you're treated as a resident and you've got a spouse that's overseas, there's a special election that you can take to make that taxpayer a resident so that you can file jointly, you can pick up the kids and all this other stuff, okay? But now you've got a non-resident alien who was never in the U.S. that is going to be subject to tax on their worldwide income. Okay, so now we have to talk about how do we get that non-resident alien to pay or to qualify for the foreign earned income exclusion, and so that now we're bringing them in so we get those benefits, but we're not causing an undue tax burden. So there's just the ability to I don't want to say manipulate because it's not manipulation. It's the ability to think about the situation outside of the confines of the algorithm in the tax software. The software may be able to say, yes, you can claim this person and give you the election to do that. But are they going to then say, well, wait a minute, now this person is bringing in their spouse. We need to look at a way to mitigate some of that double tax? Probably not. And I will also say companies like Intuit and H&R Block that offer free tax professionals, you know who they're going to for tax professionals? Me. I get emails all the time. Hey, come and join us. Intuit needs tax. So, I mean, they are, and I will also say they are also 9 out of 10. They're just as expensive or more expensive than someone who has the background in this. I see that a lot too. And this is someone who I started my career, um, my official career, I say, at Jackson Hewitt in the milk and egg section of Walmart. Okay, so I have much respect and much love for all of the same day tax return preparation services. I think some of them are really good, and I think a lot of people really need that kind of service. But when you're dealing with international, you don't want to be penny rich and pound foolish.
And the penalties really start to add up. And definitely, if you are doing your black sit and you're trying to get up out of here and you have this pool of money that you are planning to live off of, the last thing you want is the IRS to take your little pool because you forgot to fill out a form or disclose some information or whatever it might be. Something so small can be so costly. And those doggone IRS people just don't care. They don't understand. We just trying to leave. We just trying to live somewhere.
Something like it. I mean, they struggling right now too. Because they're I feel bad for them as well. But I'm probably the only one.
Oh, here we go. We got this is a good one too. It says, will I be subject to any health insurance penalty with a global health insurance plan? So of course, with the Affordable Care Act, that penalty for not having health insurance kicks in. So this is a really good question, Kristen.
That went away with the Tax Cuts and Jobs Act. The last legislation that the last administration passed, they got rid of that health insurance penalty. So you don't have to worry about that anymore. That's gone.
I won't say how I feel about that, but
okay. Okay. No.
You just know it's going. So things change.
That is the answer.
But that's a good question because I'm sure a number of people didn't necessarily know one way or the other. And if you're trying to maintain health insurance to fit something that no longer exists, but at least one, that's a big thing of why you need to have a relationship with someone who actually understands the side. Because if things change in the future, you'll need to know how to report that as well. So that's a good one. Let's see, any closing remarks? I know we've gone a little bit over an hour, but definitely some good tips and questions and insights. If you're looking to make that move, hopefully you didn't just, quit your job one day and say, y'all can have this, and got a little bit of time to plan it out and structure things out. Give us any closing marks, Katrina, as we plan this journey. And we're saying if we're 6 months, a year, whatever that might be, any closing remarks or thoughts as well.
I would say it doesn't hurt to just get a gut check and just make sure that what you have lined up is really as straightforward as you think it is. Like I mentioned, the passive foreign investment companies. If you invest in a non-U.S. mutual fund, that's a passive foreign investment company, and the filing requirements for that are very stringent. They're very complicated. The IRS recommends it takes about 80 hours to prepare a return and this is for a foreign mutual fund, meaning you go into a non-US bank and you invest in a mutual fund. You've got 80 hours worth of potential tax return preparation. You could have a foreign pension, so many different things. So it's just a good idea to have a quick conversation or just run your questions by someone to make sure that that you have a full global view of what your situation is so that you don't have any unexpected surprises.
I think that's big. And I think one of the bigger things is just planning. I mean, I understand how hard it is to sit and wait. And you're like, nah, but I'm ready to go though. Like I'm ready to go now. So I'm sure a number of people are like, yeah, thanks for telling me this, but I'm ready to go. And I don't necessarily want to wait. I don't want to wait and change. But think
All
about
right.
the
Hello,
money
hello,
side
hello,
about
everybody.
how
I want to
much
thank
that
you for.
actually can cost you in the long run. So if you don't do that planning, if you don't do that structure part, and all of a sudden you're like, goodness gracious, it's cost me a lot more. And I thought I was going to leave and go to this place, maybe with a lower cost of living, or just take some time off. I know a lot of people will deserve are doing this adult gap year where you can really decompress and have some time off and refocus and just take away the stress in general. And so you don't want to add stress to that with any IRS letters and filings, and how quickly that can add up because you're not at home, you're not getting your mail, and who knows where it's bouncing over to. And the IRS is like, I don't know, I sent it to you 2 years ago, so you owe us X, Y, and Z.
And that happens.
So, so definitely, thank you so much, Katrina. This was like amazing information, and so many I didn't know, I didn't think about that. And unfortunately, so many times we trip up and we squander our savings off of the things that we didn't know. And that's always our goal with your wealth guidance, is really making sure we guide you on your path. So your path is original to where you want to go. But at the end of the day, it's important to have a guide. The same way, if you're a traveler, the best guides in the world are the guides who can speak your native language and speak the native language of where you're going. And so Katrina is speaking the native language of the tax world. And that's important because if you don't have a true translator as you're going through all these different portions of your special guide, you don't know what things might trip you up along your path. And so I want to thank you, Katrina, for joining us, for passing along this good information for us. And I want to thank every one of you for joining, for being a part of the community today. And if we can be of any additional value, please let us know. I want to thank you again for joining us tonight, and have a wonderful night.